This 1st of May, we are celebrating investors. We have 3 knowledge-packed webinars lined up for you. The first webinar, titled India's Circular Economy, Opportunities and Challenges, held between 10 a.m. and 11 a.m., where we talk about the recycling industry and more. The second webinar, Harnessing Your Most Powerful Asset, held between 11 a.m. and 12 p.m., where we talk about how envisioning wealth creation beyond one's financial commitment can unlock that person's full potential. The third webinar, SIP to 1 crore, held between 12 p.m. to 1 p.m., where we talk about strategies to maximize your systematic investment plans. Feel free to join any webinar of your choice. See you there.
Unicorns and IPOs. Why are unicorns trying to IPO in a hurry? You've seen a lot of unicorns come to the stock market. You've seen quite a few unable to do that as well. The companies that came to the market did not come to raise money. Most of the time, the primary purpose has been to help selling shareholders. So, more often than not, an IPO in a unicorn is mainly to give exits. Yet, the stock market seems to be hyper excited whenever there is an unicorn IPO. The reason is that while a unicorn got built, while the valuation of a unicorn got constructed, public market investors were simply watching. We could not participate in them. A couple of days back, I got a request from a friend to ask me whether I would like to join him in buying shares of a unicorn. Yesterday, I saw in a newspaper release that the board of that company has approved an IPO. Often, those who have never invested in pre-IPO have a very high sense of FOMO. They feel they are missing out on something. If you see, the huge appetite for the NSE shares come from this sense of fear of missing out. People have not bought shares of Zomato or delivery or other things in the private market, so they buy NSE because it's very liquid and available. My sense is that IPOs of unicorns are going to be opportunities not for the public market investors to board them, as much as they are for those who want to get off them. So it's the selling shareholders for whom the IPOs are being done. I'm not in any way against these companies. They will eventually prove their resilience if they have it in them. Quite a few of them may become very material investment vehicles for the stock market. They would become the talking point of stock market in the future based on their business performance and profit pools that they will build over the long term. But at the point of IPO, that's not the case. A good example is Zomato. I know a lot of people constructed a story on Zomato about delivery being a great business. Now, that has run its lifetime, and beyond a point, they're not able to show the profit pool growing effectively. So, they have taken another story out of the woodworks, which is quick commerce. And I saw a recent infographic which says that out of the SOTP of Zomato, quick commerce has a higher share than food delivery. I'm sure you will have this kind of storytelling. How much of these numbers are validated is a moot point. The caliber of the people who put out these calculations has to be tested only by time. We can't judge today. But I would say that they are very, very creative. And the market needs such creative bolstering for all these unicorns. Without this creative bolstering, I doubt if it would be possible to sustain the market interest in these companies. So it's quite easy to game a market where people have a very high sense of FOMO. They feel that they have not got a chance to participate in these companies at the early stage, at the seed stage, at the Series A stage, at the multiple series stage, because it is all close to a set of investors who are not Indian investors. Except for a few, in most of the companies, the investors don't belong here. So we domestic investors have a very bad sense of being left out. And it is that sense which is pulling a lot of us into these companies well before we are seeing evidence of profit pools getting built and the companies justifying their valuations. So the valuations are continuously running ahead and we are chasing them with the hope that someday the profit pool will justify them. I think it's a bit of a man chasing his shadow game, it's something like that. But someday the shadow should be behind you. It would happen in a few companies, there's no denying that, but most of the companies may struggle because the kind of valuations you're giving before performance is not justifiable so easily, and even if the company manages to justify, it may not be able to show further growth at a rate which will justify those high multiples. The PE ratios you're giving is high, so even if a profit pool gets built, the growth of that profit pool may not justify the way you have grown the valuation. So there would be some kind of asymmetry between how the profit pool grows and how the valuation has been growing. And that asymmetry may lead to breakdown of valuations. That is generally how valuations break down in companies where the IPOs are at very high valuations and the post-IPO trades are at even higher valuations. Many people compare one company to another. They compared these platforms to the 90s when the IT companies came public. You must note that the kind of profit pools that the IT companies built over these 30 years are going to be very difficult to replicate by these platforms. I would think it is near impossible. I would be very surprised if most of the platforms manage to do what most of the IT companies manage to achieve. Maybe a few would. Maybe a very small number of platforms would achieve that number. But look at it this way, we are giving the same respect to all the platforms. So I think we are stereotyping all platforms as a reprise or a revival or a replay of the IT era. I don't think that has merit. So it's our sense of somehow trying to find something new which will give us glory in our investing that is making us do all these things. And I suspect that we are going to bear the cross because the companies have not given us guidances which are aggressive. The companies are still trying to justify performance. They are not trying to guide us more aggressively. It is the market and the analysts who are drawing evidence out of nowhere and making more aggressive forecasts. This is not something that is easy to manage as an investor. When you tell yourself that something is going to be better than what it can be, you have to justify it. And I would never want to be in that position. I would always like to assume less and see the company achieve more. If I as an investor have to assume more and then validate or justify the company achieving less, then you will have these adjusted sales, adjusted earnings, and you will keep making adjustments. Somehow that doesn't stick because that's not what great investing ought to be. Having said that, we'll have to live with what's going on. We'll have to learn from what's going on. We'll have to accept what's going on. And we'll have to outgrow what's going on. I think that's the most pragmatic approach to what's going on in the unicorn space, where private investors are selling to public market investors. The excess liquidity in mutual funds is supporting IPOs. So money is getting dumped into these investments, and these investments are still some distance away from building justifiable profit pools. That's the scenario, and that scenario is not changing anytime soon. Thank you for watching this video.